Welcome to The Explainer. Today, we're diving into one of the wildest corporate strategies we've seen in a long time. We're talking about how a software company, of all things, is trying to totally flip the script on finance by betting its future on Bitcoin.
It all kicks off with this number. Just wow. $980 million in a single week. The software company's strategy went on a shopping spree and bought almost $1 billion worth of Bitcoin. I mean, a move that big, that fast, it's gonna make some waves.
And yeah, that's the big question, right? Why on earth is a software company, one that's been around since 1989, way before Bitcoin was even a thing, going all in on digital assets like this? Well, the answer isn't about making a quick buck. Nope. It's about a plan that's designed to last for 100 years. So let's get into it. Okay, so to really get this, you got to look past the crazy price charts we all see every day. This isn't about day trading or, riding the latest crypto hype train. The company says this entire multi-billion-dollar bet is really built on a vision for financial stability that stretches out for a whole century.
So, according to their CEO, Phong, this whole Bitcoin thing, it all comes down to one of the most old-school, boring corporate jobs you can imagine. Paying dividends to shareholders. Yeah, you heard that right. It's a surprisingly traditional goal for a strategy that feels so, well, futuristic.
Okay, now this is where it gets really, really interesting. They've actually stress-tested this whole plan. So take a look at these numbers with me. If they just use their regular US dollar cash, they could cover their dividend payments until 2029. Fine. But here's where the Bitcoin comes in. Even if the price of Bitcoin gets chopped in half and just stays there, they figure they can still pay dividends until about 2065. If the price does absolutely nothing, just stays flat, they're good until the year 2100. And get this, if it goes up by just a measly 1.25%, they think they can pay those dividends forever. Wild, right? And this quote from the CEO, man, it just hammers the point home. He's making it crystal clear. Holding Bitcoin, that's the strategy. But paying those dividends, that is the absolute #1 non-negotiable priority. He's even said that if things get tough after 2029, they would absolutely sell Bitcoin to make those payments. The Bitcoin serves the mission, not the other way around. So you see, the really crucial thing here is that this isn't just about sending checks to shareholders. That consistent dividend payment, it's like a key, and it unlocks something way, way bigger. Access to a massive $60 trillion global credit market. That access to capital, that's the real prize they're after. So how exactly do you fund a multi-billion-dollar bet like this? I mean, you can't just find that kind of cash under the sofa cushions. It takes more than just a big idea. You have to build a really unique and powerful financial engine to make it all work. All right, to get how they're doing this, we need a quick primer on something called corporate leverage. All it means really is how much a company uses debt to pay for its stuff. The higher the leverage, the more debt they're carrying. And this chart right here, it just perfectly shows their secret weapon. You look at the average company in the S&P 500, and they're leveraged at around 60%. But Strategy, they're sitting at just 25%. That means they're way less in debt, which gives them this incredible amount of flexibility and stability that most other companies can only dream of. And they've pushed that advantage even further by totally transforming their debt. See, they've shifted away from the usual corporate bonds, the kind you have to pay back in 3 to 5 years. Instead, they've moved to a kind of perpetual credit. And that's exactly what it sounds like. Debt they never actually have to repay. This just massively reduces the financial pressure, letting them think in decades instead of just quarter to quarter. And what you get when you put all this financial engineering together is something really powerful. You've got low debt, you've got this forever credit, and it means they can be incredibly nimble. When they spot an opportunity in the market, they can pounce. And that's exactly what they did with that recent billion-dollar buy. But, when you're the first one to try a strategy this radical, you're gonna ruffle some feathers with the old guard. And right now, they're in the middle of a major fight with one of the biggest names in traditional finance. And the outcome of this could have huge implications for any company that wants to follow in their footsteps. So the fight is with a company called MSCI. Now, these guys are a big deal. They create the stock indexes that trillions of dollars of investment money follows. And MSCI is thinking about a new rule that would basically kick any company out of their indexes if more than half of its value is tied up in digital assets like Bitcoin. And, well, that rule seems tailor-made to target Strategy. Well, Strategy's CEO did not hold back. In an official letter about the proposal, he called the whole idea, quote, quite misinformed and misguided. So, yeah, the battle lines are drawn, and this is turning into a very public fight over what digital assets even are in the modern economy. Okay, so their argument against this has a few key parts. First, they say, hey, don't call us a fund. We're a software company that's been around since '89. They also point out that this 50% number seems totally pulled out of thin air. But their biggest point is this. An index provider is supposed to be like a neutral scorekeeper, right? They're not supposed to be the referee making up new rules and injecting their own opinions into the game, especially when it could squash innovation. And to really land his point, their CEO uses some pretty powerful analogies. He basically asks, okay, look at Chevron. 67% of their assets are oil. Should we kick them out of the indexes for holding too much of their main product? I mean, of course not. It's what they do. And then he moves on to gold. He points to a miner like Newmont. Over 61% of their assets are gold. Should they get punished for that by the index providers? When you say it like that, it sounds kind of crazy, doesn't it? And this same logic works perfectly for a company like Simon Property Group, the one that owns all of the shopping malls. A full 66% of their assets are real estate. That's their entire business model. So, this whole series of examples leads to one big, challenging question for MSCI, and really for all of traditional finance. If we're all okay with an oil company holding oil, a gold company holding gold, and a real estate company holding real estate, then why on earth should a digital asset company get penalized for holding digital assets? What makes Bitcoin so different? But beyond this fight they're in right now, strategy is really focused on the future. A future where this whole debate might just seem old-fashioned. A future where the line between traditional finance and decentralized finance just dissolves. So CEO Feng Li, he's predicting that as we get more and more regulatory clarity here in the US, the floodgates are about to open. He's convinced it's just a matter of time before the biggest names in banking are going to jump into the digital asset world with both feet. He's painting a picture of a world where your bank, names like JP Morgan and Morgan Stanley, are offering a whole menu of services built around Bitcoin and crypto. We're talking about them holding your crypto for you, letting you trade it, lending against it, even staking it. Basically, they'd be taking all the cool stuff from DeFi, decentralized finance, and offering it through the familiar, trusted channels of TradFi, or traditional finance. And this is the future they are betting the entire company on, not some small niche market, but a complete merger of these two worlds, decentralized and traditional finance, creating a whole new industry. And they think 2026 is the year it all really kicks off.
So, all this leaves us with one big final question. By using their company's money to buy a 21st century asset to fund a 20th century responsibility, are we watching the birth of a totally revolutionary new way to run a company? Or is this just a massive high-stakes gamble that could still go wrong? A cautionary tale in the making?
Don't forget to subscribe, and thanks for watching.